Hi and welcome to Swissquote's Daily Market Talk. It's Monday, September 29. The week begins on a positive note thanks to an in-line inflation data release in the US last Friday, but the US government could be shut down from October 1st onwards if US politicians can't agree on a deal to push the debt ceiling higher, a thing that is weighing on the US dollar this morning along with the dovish Fed expectations and also helping gold and silver extend their rally. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So last week ended on a positive note and this week starts on a positive note as well, and that despite fresh tariff threats from Donald Trump including pharma, trucks and kitchen cabinets. But the PCE data from the US came in line with expectations and the latter helped keeping investor mood nice and sweet after a week of hesitation. As such, the S&P 500 rebounded on Friday after 3 sessions of retreat. The Stoxx 600 index in Europe held ground above its 50-day moving average, and even the pharma-heavy SMI index rebounded from its August low levels as a confirmation that the trade news have become, well, usual bad news, and there's no guarantee that these tariffs will stay. There's no guarantee that they're not going to be doubled, for example, or halved. I mean, there's no guarantee whatsoever. They're just used as an increasingly meaningless and weak negotiation tactic, and it's just another bump on the road and nothing more. So the picture remains the same. Obviously, the tariff risk and the trade war exist. They do weigh on global growth prospects. They also do deteriorate global trade. They will lead to revised supply chains and a more divided world, but their market implications become weaker by the day. US inflation and jobs data, on the other hand, matter more because it's up to the Fed to keep the bullish trend in check. It is true. I mean, they are the one cutting the interest rates. They will be the one actually buying government bonds if things got ugly from here. And on that end, actually, news are quite encouraging because last week's impressive 3.8% US GDP growth sounded the alarm bell earlier last week and also raised questions over the necessity of further Fed rate cuts. But Friday's PCE data was again, as I said, and somehow surprisingly, very much in line with market expectations. Personal income and personal spending, on the other hand, rose more than expected by analysts, but the Fed's favorite gauge of inflation, which is the core PCE index, remained steady-ish near the 2.9% level. So significantly and persistently higher than the Federal Reserve's 2% inflation target. But some out there, including Glenn Coxon, for example, from NFG Partners, will think that the Fed has simply changed its inflation goal to 3% without telling anyone. And that letter explains why their attention is now more on the jobs front and not necessarily on inflation. So that market outlook is out there. I recommend you to go and watch. And indeed, the ample fiscal support combined with the US ballooning debt can only lead to higher inflation in the US because all that money should end somewhere. Now, speaking of these two, US jobs and US ballooning debt, well, investors' attention this week is shifting to US jobs data and also a potential US government shutdown on October 1st if US politicians can't agree to push the ceiling higher. Now, first, on the jobs front, the US economy is expected to have added around 50,000 jobs in September, which is quite weak. Wages are expected to have grown at the steady pace of 0.3%, and unemployment rate in the US is seen somewhere unchanged near the 4.3% level. So a set of weaker than expected US jobs data this week should maintain the expectation of 2 more interest rate cuts from the Fed this year alive. So the latter would pressure the US short-term yields and the dollar lower and could support equities. Stronger than expected jobs data from the US this week, on the other hand, could raise questions about the necessity of 2 more interest rate cuts in the US before this year ends and give support to the US dollar, lift the US yields, and somehow limit appetite in stocks near their all-time high levels. But that data, that jobs data, could never be published if the US government shuts down on October 1st onwards, following a failure among US politicians to avert a government shutdown. If that is the case, if the US government is not working anymore, we could eventually see both stocks and the US dollar drop as a reaction to it, with renewed pressure on the long end of the US yield curve, obviously. But now I personally believe that we are more likely than not to see a last-minute deal to avert a potential US government shutdown this week. Therefore, I actually think that it is more likely than not that the letter will just end up being a non-event, as it is more often the case, and for the rare occasions it caused actual trouble, the dips have been interesting to buy for equities, as the US government can't be shut forever, right? And the reopening process is just appetizing for investors. Now, the uncertainty still helps gold reach fresh highs, mind you. The yellow metal kicks off the new week by hitting a fresh all-time high level. It is now trading about the $3800 per ounce level at the time I'm talking here. Silver also continues this exponential rise as appetite for precious metals increases, as trust and appetite for the US dollar and US debt decreases. And that story remains in full play, mind you, and it is not necessarily a short-term allocation. So the rally that we have in precious metals is expected to extend, and that despite strongly overbought market conditions that we see there, because note that gold and silver traders love to trade the trend, and the trend is strongly positive today. But despite that little risk-off note, the week starts on a positive note for European and US futures. They're both trading in the green at the time I'm talking here. Stocks in China are up on news that Chinese industrial profits bounced 20% in August from a year earlier. Then the Hang Seng Index in Hong Kong is better a bit as well, thanks to another 3% jump in Alibaba shares at the start of this week at the time I'm talking here this morning. Here as well, the AI rally across the Chinese technology stocks remains a major play of the moment, with Alibaba obviously carrying beautifully the mascot's torch here. And to answer a question that was asked to me last week, I believe that yes, a rally to 200 mark is on the cards for Alibaba, and we could eventually see the rally extend even beyond, depending on the momentum and on appetite. In the FX space, the US dollar is downbeat this morning, as I said, on dovish Fed expectations into the US jobs data, and also on the risk of a US government shutdown that's also being priced in this morning. As such, the euro dollar actually managed to hold ground above the 50-day moving average last week and is trading above this level this Monday. And starting from today, the Eurozone countries will be revealing their September preliminary inflation figures, and on Wednesday, the aggregate CPI figure will land to the market and is expected to confirm a slight uptick in the euro area inflation from 2 to 2.2%. So the latter should cement the idea that the European Central Bank is done cutting the interest rates this year. But because that's already mostly priced in, what will really give direction to the market is the strength of the US dollar. Therefore, potential US government shutdown or soft jobs data from the US could encourage bulls, for example, to retest levels above the 118 level in the euro dollar, whereas sufficiently strong jobs data from the US and no US government shutdown should maintain resistance into that 118 psychological mark. Elsewhere, the Reserve Bank of Australia will likely keep its interest rates unchanged when it meets tomorrow, and US crude is drilling above the $65 per barrel key Fibonacci resistance, with price rallies, however, seen as top-selling opportunities on news that OPEC will continue to increase supply in November in the continuation of their supply restoration efforts. But this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.